For months, the dollar was on a winning streak, like an undefeated champion in the financial ring. Investors were betting big on Trump's economic policies, convinced they'd shake up global markets and push the Federal Reserve toward more aggressive rate hikes. And for a while, that gamble paid off. Then came February. At first, the dollar showed minor weakness. Nothing major, just a slight dip. But now, crash. The greenback has just plummeted to its lowest point of the year. So, what's behind this sudden slump? Why did the dollar take such a hard hit? And more importantly, what does it mean for you, the US, and the global economy? To get the full picture, let's rewind. When Trump's chances of reclaiming the White House started rising in late 2024, the dollar bulked up. And once he secured the win, it went full-on heavyweight mode. A solid way to track the dollar's strength is the dollar index, essentially a scoreboard comparing it to a mix of major world currencies. Looking at just the euro or the pound is like judging an athlete based on a single game, while the index gives a full season breakdown. And the numbers? They were staggering. From late September, the dollar surged upward, hitting a near 3-year high by early January. But even that doesn't tell the whole story. If you ignore the brief panic-driven spike at the start of the pandemic, when investors treated the dollar like a financial fallout shelter, this January high was actually the strongest the dollar had been since 2002. So, why did the prospect of Trump's return to power give the dollar such a boost? There are 3 key reasons. Firstly, investors anticipated that Trump would revive his signature mix of tax cuts and tariffs. This is like adding jet fuel to inflation, which in turn forces the Federal Reserve to raise interest rates. And when rates climb, holding dollars suddenly becomes much more attractive. There has long been a belief that Trump's trade wars would hurt other economies more than America, making foreign currencies less desirable and strengthening the dollar. At the same time, many in the U.S. business community were counting on his tax cuts and deregulation to spark growth, especially with the extra optimism that breakthroughs in AI would drive further progress. Then, the unexpected occurred. After a gradual decline earlier, the dollar's drop suddenly accelerated into what some might call a crash. Recently, it fell to its lowest level since the November election. It might sound dramatic, even though the dollar remains strong by historical standards. The speed of this decline is truly remarkable. This rapid plunge is the fastest seen since the pandemic, and it's unfolding even as Trump imposes massive tariffs on countries like China, Mexico, and Canada. Tariffs that, on paper, should have boosted the dollar even further. So, what's behind this sudden drop? As with any market swing, there's rarely a single culprit. One possibility is that Trump's tariffs turned out to be more targeted than expected, far from the sweeping economic overhaul he once vowed. On top of that, rapid advancements from companies like China's DeepSeek and Europe's Mistral have challenged the belief that the U.S. would dominate the AI boom. At its core, the bigger issue seems to be that instead of fueling economic expansion, Trump's policies are steering the U.S. toward a downturn. His constant back and forth, especially on tariffs, has drained confidence from both businesses and consumers, creating a cloud of uncertainty that stifles growth. Let's break it down, because once you grasp just how uneasy markets are about Trump's trade policies, the dollar's decline starts making a lot more sense. Right now, the Federal Reserve's Trade Policy Uncertainty Index, which, as the name suggests, tracks instability in global trade, is through the roof. How high? 12 standard deviations above normal. That's not just concerning. That's flashing red lights and blaring sirens territory. And as if that wasn't enough, overall economic policy uncertainty has soared to record levels, second only to the chaos of the pandemic. In simple terms, investors are rattled. And when investors start to worry, they scramble for safer bets. Once viewed as the ultimate financial stronghold, America now appears a bit uncertain. The Fed, which many expected to continue hiking interest rates, might actually ease up instead. Why? Because although Trump's tariffs and tax cuts could still drive inflation higher, the Fed certainly doesn't want to push the economy into a full-blown recession by tightening too much. Meanwhile, other major economies are practically throwing money around as if it were on clearance. Both Europe and China have doubled down on massive spending sprees. Germany has even scrapped its debt brake to unleash hundreds of billions on infrastructure and defense. Across the EU, leaders are preparing to borrow another 150 billion euros to bolster defense spending. Partly because Trump's stance on Ukraine has Europe feeling the need to look out for itself. Of course, there are serious long-term questions about whether this level of borrowing is sustainable. But in the short run, such stimulus measures are boosting growth. Just look at Goldman Sachs. They recently revised their growth forecasts upward for both Germany and the entire Eurozone, especially for 2026 and 2027. Then there's China. The CCP has rolled out a fresh stimulus package to keep its economy humming despite the pressure from Trump's escalating tariffs. And if that 5% annual growth target starts to seem out of reach, Beijing has already hinted it'll step in with even more cash. While Wall Street grows increasingly uneasy about the U.S. economy, confidence in Europe and China is on the rise. And this shift in sentiment? It's speeding up the dollar's decline. Here's the catch. While a weaker dollar isn't always a bad thing, this particular dip is raising serious concerns. A potential recession in the world's largest economy might not be a total disaster from Trump's perspective. A weaker dollar can actually boost U.S. exports and help shrink the ever-expanding trade deficit. But on a global scale, a softer dollar could bring some unexpected benefits, especially for developing nations. Since commodities like oil are typically priced in dollars, a weaker greenback would make them more affordable. Plus, for countries carrying debt in U.S. dollars, the cost of repaying those loans would drop, potentially easing the slow-burning debt crisis that's been weighing down emerging economies for years. On another note, Too Long is our regular print magazine. In the upcoming issue, we take a deep dive into the power players shaping today's world, featuring the top 25 most influential figures, ranked by both our team and you. This edition goes beyond the rankings, offering in-depth analyses of the immense influence these individuals wield. It also tackles a broad spectrum of global issues, from the challenges facing the UK to the rise of right-wing movements in Europe, and the looming question of whether peace in Gaza can hold. While our videos touch on these topics, the reporting in Too Long allows us to explore them in greater depth, providing insights that simply aren't possible on YouTube. There are 2 editions on offer, Standard and Premium. With the Premium edition, you receive not only the magazine, but also roughly 2 hours of exclusive content in which our team debates and dissects our top 25 ranking while reacting to audience votes for the first time. Additionally, you'll get regular access to our behind-the-scenes podcast, The Bullpen. For those who want to be ahead of the curve and truly understand what's unfolding before others do, here's an insider tip. Explore T-Long News. Choose any edition or section that piques your interest by visiting toolong.news. And here's the real twist. If you use the code SUBSCRIBENOW right now, you can secure a copy for as little as $4.99. That's essentially the price of a premium coffee. But instead of a caffeine kick, you're feeding your mind with genuine insights. Every bit of support matters, because, let's be honest, quality journalism doesn't pay for itself.